Hello, everybody, and welcome back. Today, my guest is Andrew Mattock. Andrew is a portfolio manager at Matthews Asia and manages the firm's China strategy as well as the China small companies strategy of Matthews. Welcome, Andrew.
Thank you. Thanks, Thomas. Thanks for having me.
So, Andrew, today we want to discuss current trends in Chinese financial markets and also current investment opportunities. And so we have seen a strong Chinese economy even during the pandemic year 2020. How is 2021 going so far? What are the main drivers for Chinese equity market?
Yeah, Thomas, as you know, China was first in and first out in terms of the virus, and the containment of the virus went, relatively successful in China. So we did see a return to normal a lot quicker than the rest of the world. So generally speaking, the economy started to function, if you like, or progressed, if you like, a lot more smoothly out of the virus situation. So just general economic activity in China returned to normal a lot quicker. So that's the number one thing. The second thing is the rest of the world was locked at home. And, as you know, as probably everyone else knows, there was a lot of clicking of the Amazon button, if you like, as, we couldn't go to restaurants and we couldn't go and do the things from a service sector point of view that we used to do. But as you know also that when you click that Amazon button, it's called Made in China. China, from an export perspective, not only just does end assembly, it progressed very aggressively over the last 10 years to backwardly, vertically integrate the whole supply chain within China itself. So the export side of the economy, as well as domestic consumption in goods in particular, coming back, has seen a lot of strength in the industrial side in China. So, in terms of where we are today, from that point of view, things are stronger, if you like, relative to even 2019. The area that's still not back to normal is the built-in COVID, what you would call behavior, which is people being a little bit more reluctant to go out of the house, the services side, the restaurants, that's not quite there. It's still grinding its way back, but I think the behavior of COVID has sort of stalled, if you like, that sort of going out, restaurants, those other services type things that people do, that's still grinding away. It's grinding in the right direction, but that side of the economy is still not quite there. But we expect that over time, when all the fears of the virus go away, and people in China are still, it's still in the back of their mind. There's still cases there on a daily basis, and we expect that to come back to 2019 levels as well.
Hi there, just a 2-second break. Before we continue with the video, just make sure to subscribe to our channel now to not miss out any updates. Thank you very much and enjoy the video now. There's currently a shift in China's economic structure going on. Can you tell us a little bit more about it?
It's been a gradual progression, but really the financial crisis, if you like, was the wake-up call. As they overdid the stimulus, if you like, in the financial crisis, they realized that there was excess capacity in fixed asset investment. And so the reform process really started then as they tried to redeploy, if you like, the savings pool in China. You gotta remember the savings pool, the savings rate in China is over 30%. And those savings, a lot of those savings were being directed by banks into fixed asset investment. That started to change. The government realized that it needed to develop the consumption side of their economy more aggressively. And they stopped deploying capital into those areas, and there was a huge encouragement of the domestic consumer base to develop more into consumption and services. So it's really been going on as a gradual progression. I don't know, but by luck or by chance, I don't really know, but the internet model, if you like, where you had a smartphone, you had a business model like Amazon where you could buy things and get them delivered, and you already had the infrastructure in China's case in terms of road and rail and logistics, really accelerated that consumption trend, if you like. And what we saw was this sort of explosion in untapped potential of the Chinese consumer start to emerge. And really, I think the internet side of things really allowed these consumer brands to reach consumers in places where previously you needed bricks and mortar retail. You no longer needed that. And China's a vast place. So to be able to get goods to people in these lower tier cities, within 2 days was a huge tailwind, if you like, of developing this consumption economy. And really in the last 5 years, we've just seen an acceleration of that trend. And the government continually promoting consumption with tax cuts, with obviously minimum wage rises across the country year in, year out, to put more of that money in terms of China Inc. into consumers' hands. So it hasn't just occurred. It's been a progression, but I would say it has accelerated aggressively in the last 5 years. And I think a lot of that's got to do with, the internet model, the reach that these consumer brands can get to customers. And now we're seeing in the last 2 years, services, in particular services, whether that's pet services or, things you find, common in the high streets of most countries. That's the side that I think is now accelerating more aggressively than even the good side, which, like I said, really started 10 years ago and then really accelerated 5 years ago.
So you already mentioned the success story of the internet economy, and namely Alibaba and Tencent, some of the technology incumbents, but also other stocks from the hard and software industries already reached lofty valuations, and many investors are afraid of that, if there could be some kind of bubble. So what's your take on that? What do you think about current valuations?
Really, when you look at why it occurred, so, if we back up a bit into the trade war with Trump, there was a real concern in China about what you would call the reliability of the supply chain, particularly in hardware, actually. And what we saw at a company level is that concern being reflected in the reallocation of orders, where there was a Chinese-orientated competitor relative to a global competitor, started to receive preferential treatment when it came to order flow. Now, the technology of some of these companies, they were still catching up. They weren't quite there. But because of the reliability of the supply chain, it made sense to long-term place more of those orders with the domestic supplier in China. As a result of that, fundamentally, investors obviously caught wind of it, and the valuations of lots of these stocks, as those orders were being reallocated to a Chinese-orientated supplier, went aggressively upwards in terms of valuations, to a point where I think things have become stretched. Nothing happens overnight in terms of technology catch-up. On the software side, China was always a long way behind, and the cloud infrastructure, the development there, has continually promoted the development of again, homegrown software, because they can't rely, because of hacking and concerns around national security, they would rather develop their own software as well. So that's also been a huge promotional point from the Chinese government's industrial policy. And so we've seen a lot of, if you like, funds, direct money into software development in China at the same time. So there's very good reason why technology, fundamentally at a bottom-up perspective, hardware, software, has run very hard, because there's a big opportunity in terms of foreign replacement and also domestic development. And I know people talk about innovation, but China has a lot of catch-up to do. So innovation's great, but if you think of where China's coming from, particularly in software and even in hardware, in terms of just catch-up, there's a lot of what you would call total addressable market that China needs to look after itself. On the platform side, the valuations there aren't stretched at all. And I think it's got a lot to do with where the companies are listed. Alibaba and Tencent, as you know, are listed in Hong Kong now, as well as Alibaba are listed in the US. These platform companies, if you like, the valuations there aren't nearly as stretched. And, there is a bit of a disconnect between what technology companies will be priced at in the Asia market versus Hong Kong at this point in time. So those types of companies, I think, actually offer very good value at this point. And that's partly because of who's pricing the stock, I think.
So which Chinese sectors or industries provide currently best investment opportunities 2021 for investors? And where do you find value opportunities for your funds?
It's a good question, Thomas, and I'd like to answer it quickly. But when I look at the Chinese stock market today, just the number of opportunities across sectors is just so wide. And I can give you a few examples and diversity of examples, actually. So I'd start with automation. As you know, wage costs in China are rising. They still want to control the supply chain within China itself. So automation, again, the catch up in just technology that exists overseas in automation that doesn't exist in China is a huge opportunity, because labor costs are driving companies to become more efficient in that area. And then you switch over to something like consumer finance. Consumer finance has been on a gradual rise in China, but they've now started to work out the regulatory framework in terms of providing finance into the consumer sector more succinctly. So I think there's an opportunity there, as well as lending into the SME sector. Small, medium-sized businesses in China have never had access to credit like we would associate in the Western world. There's another pot, if you like, of opportunity in that area. In addition to that, what we're seeing, because of the demand, like I said, in Chinese consumption demand, particularly in goods, so not only is China producing goods for the rest of the world, it's producing it for itself as well. And that's actually leading to a shortage in all types of what you will call more complex chemicals, or commodity chemicals, if you want to call them, specialty chemicals, that whether that be glass fiber, rubber resins, MDI, that go into the fridge, that close the fridge door, all types of more complicated chemicals that feed into these goods, which are now in high demand in China, and also obviously the continual demand from the rest of the world. There's opportunities in that area. And we've already mentioned hardware and software. And, let's not get carried away with innovation. Let's just believe that China has a long way to catch up. And I think that's even more powerful story than actually believing in innovation. So, there's some areas for you, without even going into healthcare, and there's opportunities there. But it's volume healthcare that we're focused on. It's not as much innovation healthcare, although that does exist. The policy of providing universal health coverage at an affordable price to the Chinese population, there's a lot of opportunities within that supply chain from a volume perspective. So that just gives you a feel. But what I would say to investors is, don't get too fixated on one part. There's a lot going on in China, and that's really a hallmark of Xi Jinping's reign. It's all about micro reform. It's all micro reform that's been occurring in China now for a long time.
So this was Andrew Mattock from Methods Asia. Thank you very much, Andrew, for sharing your views and insights in China investing today.
Thanks, Thomas.